crisis in 1991 triggered large-scale structural reforms, deregulation of the economy, financial sector liberalization, and a shift towards market-determined exchange rate. In the wake of the trade and financial sector reforms and the consequent rise in foreign capital flows and financial innovations, the efficacy of broad money as an intermediate target came under scrutiny around the mid-1990s. At the same time, there was a notable shift towards market-based financing for both government and private sector. In this environment, a multiple indicator approach was adopted in April 1998 as the new framework of monetary policy. Under this approach, a host of indicators constituted the information set used for monetary policy formulation. The restrictions on primary financing, which was imposed from 1997 onwards, the enactment of the Fiscal Responsibility and the Budget Management Act in 2003, that is the FRBM Act of 2003, and the consequent introduction of fiscal discipline provided enhanced flexibility to monetary policy, increased market orientation of the domestic economy, and deregulation of interest rates introduced since early 1990 domestic economy and deregulation of interest rates, which was introduced also at the same time. The multiple indicator approach remained in vogue from 1998-99 till the global financial crisis 2008-9. Now, during the years following the global financial crisis, I now turn to the flexible inflation targeting framework and how it evolved. During the years following the global financial crisis in 2008, India witnessed stubbornly high inflation, with retail inflation in double digits and growth losing momentum. India's macroeconomic fundamentals appeared fragile, with widening twin deficits in both fiscal and current accounts, and India also witnessed depleting forex reserves. The global ripples created by the taper talk of May 2013, and also part of it was in June of 2013, exposed the macroeconomic vulnerabilities of India, and the country was identified as one among the fragile five. These events called for an evaluation of the multiple indicator approach. Accordingly, an expert committee was constituted in the Reserve Bank of India to revise and strengthen the monetary policy framework. The committee recommended a shift to flexible inflation targeting framework, which was formally institutionalized with the amendment of the Reserve Bank of India 1934, and this amendment was done in the Parliament in May 2016. Incidentally, I was Secretary Economic Affairs in the Ministry of Finance at that time, dealing with the adoption of inflation targeting framework. The amended act gives a clear mandate to the Reserve Bank to maintain price stability, keeping in mind the objective of growth. Price stability has been numerically defined as maintaining a headline CPI inflation target of 4% with a tolerance band of 2%, that is plus minus 2% on either side. So if it is between 2 to 6%, it's not considered a failure of monetary policy, but the target remains 4%, and it is expected, it is mandated that the Reserve Bank should achieve the target of 4%. The tolerance band provides flexibility to accommodate growth and financial stability concerns, supply shocks, and measurement and forecast errors, and also on any unforeseen development that may happen, as we witnessed in the recent years. The target is set by the Government of India in consultation with the Reserve Bank every 5 years. So for the first part, from 2016 to 2021, the target was 5 years. The target was 4%, and thereafter the same target has been renewed for the subsequent 5 years. Another major change with the amendment of the Reserve Bank of India Act in 2016 was the shift from a governor-centric, that is the RBI governor-centric monetary policy decision-making process, to a collegial decision-making body in the form of the Monetary Policy Committee. The Monetary Policy Committee, or MPC as it is commonly known, is entrusted with the responsibility of deciding the policy repo rate with the objective of achieving the inflation target, keeping in mind the objective of growth. I am happy to recall that Professor Pami Dua was an esteemed member of the first MPC, and the Reserve Bank benefited immensely from her distinguished academic rigor and practical insights. I'm also happy to see in the audience Professor Chetan Ghate, who's here, and he was also a member of the first Monetary Policy Committee, from 2016 onwards. The decisions of the MPC are taken by a majority of votes among the members present. In the event of a tie, the governor has a second vote or a casting vote. After the conclusion of every monetary policy meeting, the Reserve Bank publishes the resolution adopted by the Monetary Policy Committee. In addition, the governor's statement and press briefings are the other modes of policy communication. The minutes of each of the members of MPC are also published exactly after 2 weeks of the conclusion of the Monetary Policy Committee meeting, and that is provided for in the law in the interest of greater transparency. Similarly, every 6 months, the Reserve Bank comes out with a monetary policy report which broadly captures the way the monetary policy has evolved, the way the macroeconomic situation has evolved over the previous 6 months. Now, all these provisions add to transparency of the whole process and better communication of the whole process. Now, this is a forward-looking monetary policy, and which has therefore underlying which is the importance of forecasting. So I would now like to therefore focus on aspects of the forward-looking monetary policy and the importance of forecasting. As monetary policy works with long and variable lags, the forecasts of key economic variables play a vital role in the conduct of monetary policy. It is for this reason that inflation targeting framework is also termed as inflation forecast targeting framework. To take a real-life analogy, the conduct of monetary policy is like driving a car on a road with potential ditches and speed bumps. The driver needs to see them ahead and in time to regulate the speed of his car. Yes, to regulate the speed of his car and to negotiate the ditch or the speed bump smoothly. If the driver reacts suddenly to a speed bump, he runs the risk of losing control and causing an accident. Therefore, a successful conduct of monetary policy depends critically on credible forecasts of key variables like inflation and growth. In other words, monetary policy has to be forward-looking. Rear-view mirror can lead to policy errors. The forecasting process followed at the Reserve Bank has 3 broad components. They are nowcasting, short-term forecasting, and medium-term forecasting. Am I making sense? Or should I switch over to... is it okay? Okay, right. The first component of nowcasting, the first component of these 3 approaches, that is nowcasting, it uses high-frequency coincident indicators for the current month or the quarter that are available ahead of the official data releases on inflation and growth. This is augmented with informed judgment based on extensive discussions with subject area experts, forward-looking surveys which the Reserve Bank conducts from time to time, and market intelligence. The second component comprises short-term forecasts for up to 1 year. These are generated from semi-structural models that employ 3 time series and econometric methods using aggregate and disaggregated data and information from forward-looking surveys and lead indicators. The third component involves generating medium-term forecasts and alternate scenarios using what we call the QPM, that is the quarterly projection model. This framework has been widely accepted. That is, the QPM framework has been widely accepted and adopted by modern central banks operating under the flexible inflation targeting regime. Its main purpose is to generate medium-term projections and policy analysis consistent with achieving the inflation target or the mandate set under the inflation targeting framework. Each of these three components which I mentioned, that is the nowcasting, the medium-term forecast and the QPM model, each of these three components, they have different forecasting horizons and hence different approaches. These forecasts therefore become the backbone of the monetary policy decision-making process. I would now like to turn to conduct of monetary policy under the flexible inflation targeting framework, and here let me highlight the following points. Now, I would like to sort of highlight here how the monetary policy, the inflation targeting framework, how it has been used from 2016 onwards, especially the period when the growth seemed to be slowing down in 2019. In view of the tepid growth outlook for 2019-20, the Monetary Policy Committee, that is MPC, moved into a rate easing cycle from February 2019 to stimulate economic activity. During February to October 2019, the policy repo rate was reduced by 135 basis points from 6.5% to 5.15%. Also, the stance of monetary policy was changed from neutral to accommodative in June 2019. If some of you or if all of you have seen the resolution of the monetary policy, there are broadly two major announcements which we make. One is what is the policy repo rate, whether we are increasing it, reducing it, or we are maintaining status quo. The other thing which we say was what is the stance of monetary policy. And the stance of monetary policy basically reflects the approach of the monetary policy and how it sees the, what is his broad approach in current times, at the current, at present, and how it sees the next few months and what would be its overall approach. So therefore, usually when we are in a rate tightening cycle, it's called, it's in a tightening mode. When we are in a rate easing cycle, we are in an accommodative mode. And there is something called the neutral stance also, which is neither accommodative nor tightening, which basically means that you are, it is wait and watch. At the moment, our monetary policy stance is withdrawal of accommodation. I will talk about it, more later. In effective October, that is effective from 1st October 2019, the external benchmark-based lending rate system was also introduced, which quickened the pace of policy transmission into lending rates. So what we mandated is that the banks, when they extend loans, particularly to certain sectors like retail loans, MSME loans, or housing sector loans, it has to be benchmarked to either a government security of, either the treasury bills or government security of 10 years government security, or a government security of equivalent maturity. Let us say if you are giving a 3-year loan, what is the interest rate prevailing, the market rate, the yield prevailing in the market for a 3-year loan, for a 3-year government security. So your lending rate is linked to that. And this was done in October 2019 primarily to ensure better transmission of monetary policy to actual lending rates by the banks. Now, when the COVID-19 pandemic hit India, the monetary policy responded swiftly by reducing the policy repo rate sizably by 115 basis points in a span of 2 months, that is during March to May 2020. In parallel, the Reserve Bank infused large amounts of liquidity through both conventional and unconventional measures to stimulate the economy, restore confidence, and revive market activity, while ensuring that these measures did not engender future fragilities. Overall, liquidity enhancing measures worth rupees 17.2 trillion, that is 17.2 lakh crores, or 8.7% of GDP, were announced during the COVID period. All these measures were taken in view of the large output losses, although pandemic-induced supply disruption and demand mismatches pushed inflation levels higher than 4%. The flexibility embedded in the inflation targeting framework enabled the Monetary Policy Committee to take these measures to safeguard the economy and the financial sector from the debilitating impact of the pandemic. In October 2020, the Reserve Bank noted that a stable and orderly evolution of the yield curve was a public good. Because I had said earlier that most of the bonds in the private sector, or most of the lending is actually linked to the interest rates prevailing, the market rates prevailing on the various government securities. So therefore, what is critical is whether your bond rates, that is the government bond rates, whether they are high or low, and how they are. Because all the lending rates in the market, whether through corporate bonds or other kinds of bonds, they are benchmarked to the prevailing yields or the prevailing interest rates, the market interest rates on government securities. So in Reserve Bank, in October 2020, we noted that a stable and orderly evolution of the yield curve was a public good, the benefit of which accrues to the stakeholders in the financial system. Since you would be aware that, a central bank like Japan, for example, they have a stated policy of what is called yield curve control. Their monetary intervention, their monetary decisions of their, the Central Bank of Japan, their decisions primarily target on controlling the yield on the government securities. We are not in that, we don't adopt that approach. But during that period of COVID, when it was absolutely necessary to ensure that, whatever monetary policy which we were taking, and that was transmitted to the market, it was absolutely also necessary that we maintain the yield curve of government securities in a manner that government borrowing also goes through smoothly, as well as whatever are the interest rates set by the MPC are actually transmitted to the market. And it was necessary in the kind of extraordinary circumstances which we encountered during the COVID-19 period. But yield targeting is not a part of our policy in normal times. It was only for a temporary period that we gave a forward guidance, wherein we only said that it is a public good, the benefit of which generally accrues to all stakeholders in the financial system. Since monetary policy transmission through the regular interest rate channel was impeded because of inadequate credit demand during the pandemic, as I mentioned a little while ago, the Reserve Bank activated the asset price channel through large-scale purchases of government paper through open market operations, what we call OMOs, and secondary market government securities acquisition program, what we call GSAP. This was again an innovative thing which we did, and RBI had never earmarked a part of its balance sheet for purchase of government securities. The idea is that we purchase the government securities with two objectives: that to infuse liquidity into the system, and number two, to ensure that the yield curve on government securities that also evolves in an orderly manner. Large purchases of government paper softened the GSEC yields, which in turn facilitated the lowering of the yields, that is the interest rates, on all instruments priced off the yield curve. The pandemic-induced liquidity measures that we undertook in India by the Reserve Bank were unique in several ways. Why I am saying unique is that it is unique compared to the approach which was adopted by most of the central banks around the world, especially the advanced country central banks. And our decisions and policy was unique in several ways. Let me list them out. Number one, liquidity was provided only through Reserve Bank's counterparties for on-lending to stressed entities and sectors. In that sense, most of it was targeted and not open-ended. In other words, when we injected liquidity through the banking system, it was specified that it is targeted towards the MSMEs, or it is targeted towards the small size NBFCs. So it was targeted, it was not open-ended. Because if you just in an open-ended manner you just put in liquidity into the system, it can create asset price bubbles, which can again backfire and which can hit you back. So therefore, whatever liquidity we injected, they were targeted, and they were also provided through Reserve Bank's counterparties, that is mostly banks and all India financial institutions like the NABARD, the SIDBI, and the National Housing Bank. The second uniqueness about our approach was that asset purchases program, that is GSAP, Government Security Acquisition Program, was announced for a limited period of 6 months and was much smaller in size than advanced economies. And this was confined to government securities in the secondary market. Third, collateral standards were not diluted in the lending facilities. 4, loan resolution frameworks for COVID-19 related stressed assets of banks and NBFCs. We announced a regulatory framework for treatment of the stressed assets of the banks, because we announced a moratorium on repayment of bank loans for 6 months. And then because of the COVID pressure and because of a stoppage of economic activity, naturally the loan terms and conditions of large number of loans had to be restructured. So while doing that also, the loan resolution framework, or what you call the loan restructuring framework, that also they were not open-ended, and they were subject to achievement of certain financial and operational parameters. This is something which we learned from past experience, because in the past experience, most of the restructuring framework which were announced by the Reserve Bank, this kind of parameters and guardrails were not imposed. As a result, it was found later on that the restructurings were done for periods, or for, the installments were fixed in a manner which were highly impractical and not at all feasible, leading eventually to a mounting size of non-performing assets, or what we call stressed loans or bad loans. So learning from past experience, this time our resolution framework was not open-ended, but we imposed that after restructuring, this is the kind of financial parameter, this is the kind of operational parameter the business entity should achieve. And 5, most of the liquidity injection measures had pre-announced sunset clauses, which helped in an orderly unwinding of liquidity on their respective terminal dates without de-anchoring market expectations. You see, it's much easier to infuse liquidity into the system, but it's very difficult to pull it back, because the market gets used to it. Every economic player in the market, everybody gets used to it. And then suddenly when you squeeze it, then it becomes, it creates a lot of disruption in the financial system. And also for central banks, it becomes a very difficult decision to decide on the timing of withdrawal. So most of our liquidity injection measures were announced for 1 year period or 3 years, so that the banks and the other borrowers who avail this liquidity, they knew that they have to return it in 1 year or in 3 years. Now this enabled them to plan their activities in a manner which will enable them to return that liquidity, return that money to the central bank, that is to the Reserve Bank, after 1 year or 3 years. And so therefore that is something which Reserve Bank we did, and in that sense it was quite unique, because most of the advanced country central banks injected liquidity, and later on it becomes very difficult to withdraw it, and we are currently witnessing it with many advanced economies, central banks still trying to take out the liquidity. And when they are now trying to take out the liquidity, we are hit by fresh crisis arising from the Ukraine war, and now with all that is happening around the world. So therefore a copy of this speech will be uploaded in the RBI website, so you can have a look at it. So basically what I'm saying is that, going by past experience and working as a team, the Reserve Bank was able to, we were able to sort of adopt a completely unique and innovative approach, which has enabled the Reserve Bank to sort of roll back the COVID time special measures which were undertaken. And unless you roll them back in time, it will sort of undermine financial stability. And that is one of the fundamental reasons for the fact why we have, there are other factors also, but this is also one of the reasons, for the fundamental reasons for why, as to why we see financial stability, banking sector stability and overall macroeconomic stability in our economy. Now, let me now focus on the global upsurge in inflation and monetary tightening cycle. I talked about the COVID period. Now let me move to the post-COVID period. In early 2022, inflation in India was expected to moderate significantly with a projected average rate of 4.5% in 22-23. This was premised upon an anticipated normalization of supply chains, the gradual ebbing of COVID-19 infections, and a normal monsoon. Such expectations were, however, belied by the outbreak of hostilities in Ukraine in February 2022. Initially, the shocks came from food and fuel prices, which were mainly global in origin. But local factors from adverse weather events also played an important role in stoking food inflation. Last year, you remember, in March, April, we had suddenly a severe heat wave, as a result of which there was a large-scale failure of the wheat crop, and that added to, that was one of the major domestic factors which contributed to food inflation in particular. Now, the shocks to inflation, all these shocks to inflation got increasingly generalized over the next few months. Under these circumstances, the monetary policy quickly changed gears by prioritizing inflation ahead of growth in April last year, that is in April 2022, and changed the stance of monetary policy from accommodative stance to withdrawal of accommodation in June 2022. So this is what I had referred to earlier. Now the stance of monetary policy is withdrawal of accommodation. In an off-cycle meeting in May 2022, that is last year, the MPC raised the policy rate by 40 basis points. This was followed by rate hikes of varying sizes in each of the 5 subsequent meetings till February this year. In all, the policy repo rate has been raised by 250 basis points cumulatively between May last year to February 2023. The quantum of rate hike was calibrated, keeping in view the changing inflation outlook. We have maintained a pause in April, June, and recently in August meetings of the MPC, as we feel that the 200 basis points hike is still working its way through the system. Headline inflation had eased to 4.8% in June 23 from the peak of 7.8% in April 22, that is April 2022. It, however, surged to 7.4% in July, mainly on account of a spurt in vegetable prices, which have already, of course, started moderating. As I noted in my monetary policy statement on 10th August 23, that is last month, given the likely short-term nature of vegetable price shocks, monetary policy can await the dissipation of the first-round effects of such shocks, which may produce short-lived spikes in headline inflation. We remain on guard to ensure that the second-order effects in the form of generalization and persistence are not allowed to take hold. The frequent incidences of recurring food price shocks pose a risk to anchoring of inflation expectations, which has been underway since February 2022. We will remain watchful of this aspect also. The role of continued and timely supply-side interventions, as is being undertaken by the government, assumes criticality in limiting the severity and duration of such food price shocks. In these circumstances, it is necessary to be watchful of any risk to price stability and act timely and appropriately. We remain firmly focused on aligning inflation to the target of 4%. Let me now turn to the last part of my lecture, which focuses on policy issues and challenges which we are confronted with. The current episode of high global inflation and the preceding overlapping shocks of the pandemic and the Russia-Ukraine war have raised significant issues and challenges for the conduct of monetary policy. First, the flexible inflation targeting framework and the target of 4% was put to test given the multiple challenges faced by the economy due to the pandemic. So when the inflation target was to be reviewed in early 2021 and notified for the next 5 years, the Reserve Bank reiterated and recommended for retention of the 4% target. It was stressed that the target and flexibility built around it had helped the Reserve Bank to support the economy when required and shift gears and reprioritize inflation over growth if inflation became high and breached the upper tolerance level of 6%. In fact, this is precisely what happened when there was a sudden surge in inflationary pressures following the war in Ukraine. The pursuit of flexible inflation targeting and the maintenance of the 4% target demonstrated our commitment to price stability and enhanced the credibility of monetary policy. When I say credibility of monetary policy, I basically mean that it also helps to anchor inflation expectations of businesses and of households and of everyone in the economy. Because if the central bank says that I am okay with a higher inflation level, then naturally business start expecting that the prices will go up, and actually it materializes in terms of rise in prices. So a reiteration by the central bank that we are committed to 4%, as we have been doing time and again, and the fact that we again recommended to government, despite the fact that inflation was prevailing at that time upwards of 5% and touching 6 and sometimes above 6, the fact that the Reserve Bank recommended 4% and stuck to that target also established the credibility of the monetary policy framework and also gave confidence to the market and also helped in anchoring inflation expectations. The second challenge which monetary policy faces is the level of liquidity in the system and the important role it plays in determining the actual overnight call money rates or the weighted average call money rate, WACR, which is the operating target. You see, when we announce the monetary policy, the expectation is that it will transmit to the actual lending rates in the economy. But the actual success of the monetary policy is measured in terms of the overnight call money rates. And of course, later on, whether the rate is transmitting into the bank loans and to the other loans which are taking place in the market, which are being loans which are granted in the system by banks or NBFCs. But primary instrument, primary measure of success of monetary policy is, monetary policy reflects itself in the overnight call rates, or what we call the WACR, that is the weighted average call money rates, which is the operating target of monetary policy. So the operating target, the overnight call rates should ideally be the same as the policy repo rate. If the policy repo rate is 6.5%, then by and large the WACR, that is the overnight call rates, also should be around 6.5%. Now monetary policy, our policy rate is 6.5. So the overnight call rates also should be around 6.5%. Now the MPC decides the policy repo rate and the stance of monetary policy. Thereafter, it is the Reserve Bank's responsibility to conduct its liquidity management operations in consonance with the decision of the MPC. During the pandemic, while the MPC reduced policy repo rate by 115 basis points within a span of 2 months, the Reserve Bank infused significant quantum of liquidity, driving the overnight call money rates closer to the reverse repo rate. That is, less than the repo rate. Repo rate that time was 5.15%, but the reverse repo rate was 3.35%. Because we infused large quantum of liquidity in the system, the overnight call rates were hovering around 3.3 or 3.35%. And it was done by design to ensure that the actual overnight call rates are low and that the actual affordability of businesses to avail credit also is improved to that extent. Now, this was done to stimulate the economy, restore confidence and revive market activity in consonance with the accommodative stance of monetary policy. As the MPC's focus shifted to withdrawal of accommodation last year in June, In the wake of surge in inflation following the commencement of war in Ukraine, the Reserve Bank's liquidity management operations focused even more on gradual and calibrated withdrawal of surplus liquidity in a non-disruptive manner. Actually, we had, because of the preset dates by which, that is the 1 year or 3 year period for which the liquidity was injected, already in the, in the automatic mode, liquidity was coming back. Besides that, from 2021 onwards, we had also introduced something called the variable rate reverse repo operations. I am not going to detail into it. It is there explained in a footnote of this paper. You can refer to it. So when the withdrawal of accommodation became the stance of monetary policy last year in June, we also renewed our efforts and started pulling out liquidity even more. And this was done in a very non-disruptive manner. The objective was to reduce the size of the liquidity surplus in the system to a level consistent with the prevailing stance of monetary policy. Overall, liquidity management by the Reserve Bank has been nimble-footed and agile while responding to evolving circumstances. The third aspect, the third challenge which we face is, and which is something which we have learned and which our experience has shown, is that our experience in recent years shows that supply shocks have become more frequent with profound implications for inflation management and anchoring of inflation expectations. A key risk of sustained high inflation is that it can de-anchor inflation expectations. It is therefore important to remain vigilant and take necessary steps in a calibrated and timely manner to keep expectations firmly anchored. The Reserve Bank has been quick and calibrated while navigating through such turbulences. We look through fleeting shocks but remain prepared to undertake policy responses if such shocks show signs of persistence and getting generalized. In such a scenario, monetary policy has to focus on containing the second round effects. Fourth, price stability and financial stability are complementary to each other. In fact, price stability is an anchor for financial stability. But sometimes the trade-off between the two becomes a close call, as demonstrated in the recent banking sector turmoil in some advanced economies. We witnessed the failure of a few commercial banks in the United States and the failure of the Credit Suisse, which is a large institution in Switzerland. Now, after a near zero policy rate for a prolonged period, central banks in these economies started raising interest rates aggressively in 2022, which contributed to stress in certain banks in these economies. In contrast, our battle against inflation is not constrained by financial stability concerns. In fact, even during the COVID phase, we continuously took measures to strengthen financial stability. The Reserve Bank has adopted a prudent approach and taken a number of initiatives to revamp regulation and supervision of banks, NBFCs, that is non-banking finance companies, and other financial entities by developing an integrated and harmonized architecture. Our banking system remains resilient and healthy with improved capital ratios, asset quality, and profitability. Fifth, central bank communication plays a very vital role in on-ground efficacy of monetary policy. A few decades ago, central banks believed that they should be, I quote, shrouded in mystery, again I quote, say as little as possible and say cryptically. Former chairman of the Federal Reserve, Alan Greenspan, had famously remarked, "If I seem to be unduly clear to you," I repeat, if I seem, that is, I am quoting Alan Greenspan, "if I seem unduly clear to you, you must have misunderstood what I said." Those times are gone. Now, managing expectations through effective communication is a vital instrument in the monetary policy toolkit. In the case of Reserve Bank, effective forward guidance during the easing cycle reinforced the impact of our conventional and unconventional measures during the pandemic. At the height of the pandemic during 2020 and 21, the MPC prioritized growth over inflation. In fact, when inflation was above the upper tolerance level of 6% in July-August 2020, we provided both state and time-based forward guidance of continuing with accommodative stance of monetary policy as output remained well below its pre-pandemic levels. Besides, our forecast also showed that inflation was likely to soften gradually. In the second half of 2021, inflation eased in line with our assessment. In the tightening phase, which commenced in April-May 2022, that is April-May last year, the scale and nature of communication has been appropriately fine-tuned and calibrated to ensure successful transmission of policy rate hikes. The focus has been on anchoring of inflation expectations by emphasizing our firm commitment to realign inflation with the target. Overall, central bank communication has to be balanced. Too much of it may confuse the market, while too little may keep it guessing. We trade a very fine line and constantly endeavor to refine our communication strategies. Now, let me conclude by saying that monetary policy framework in India has evolved in line with the developments in theory and country practices, the changing nature of the economy and developments in financial markets. Within the broad objectives, the relative emphasis on inflation, growth, and financial stability has varied across monetary policy regimes since independence. Our experience during the inflation targeting regime provides some useful lessons for conduct of monetary policy. First, being proactive and nimble-footed during a crisis gives one the ability to respond speedily to fast-paced and overwhelming developments. Second, policy measures should be prudent, targeted, and calibrated to the need of the hour without being tied down by any existing dogma or orthodoxy. Third, monetary policy actions, when needed, should be backed up by appropriate regulatory and supervisory measures, including macroprudential instruments, to reinforce the policy impact and its credibility. Fourth, guidance and confidence need to be provided to the market and the wider public through effective communication as part of the endeavor to anchor inflation expectations and sentiments appropriately. All these principles were firmly embedded in our actions during the multiple shocks in the recent period. Alan Blinder, who wore both the hats of being an academician and a practitioner, once said, I quote, "Having looked at monetary policy from both sides now, I can testify that central banking in practice is as much an art as science," unquote. As students of economics at this prestigious Delhi School of Economics, I am sure you are well versed with the science of monetary policy as a macro stabilization tool. I took this opportunity to throw some light on the art of monetary policy making from a practitioner's perspective, especially in a dynamic and uncertain environment as we witnessed in recent years. As we continue our journey ahead, we remain clear in our focus, flexible in our approach, and determined in our efforts to strengthen India's macroeconomic fundamentals and support its growth story. I'll stop here. Thank you very much for your hearing.